China just weaponized silver. Export controls went live 72 hours ago. The CME noticed immediately. Contract delivery failures spiked. Physical premiums exploded overnight. This isn't a policy shift. This is economic warfare through commodity strangulation. The London vaults are scrambling. COMEX warehouses show stress fractures. Shanghai premiums hit 20-year highs. I've tracked precious metals for 15 years. I've never seen institutional panic move this fast. The paper market is discovering something terrifying. China controls the metal. They always have. This is not normal. Let me bring you up to speed on what happened. December 28, 2025. China's Ministry of Commerce announces temporary export restrictions on silver products and antimony. The official reason? National security and resource management. The real reason? Strategic metal dominance. Here's what they're restricting: refined silver bars, industrial silver compounds, silver-bearing alloys, and critical processing technology. Essentially, if it's silver and it's leaving China, Beijing now has veto power. China produces 33% of global mined silver. But here's the part that matters. They refine 47%. They're not just a major producer. They're the processing bottleneck. Within 12 hours of the announcement, I'm watching Shanghai Silver Exchange premiums jump $4 per ounce over London spot. By hour 24, it's $6. Industrial buyers in Germany and Japan start panic bidding. Then the CME chaos begins. January delivery contracts on COMEX start showing irregularities. Delivery notices get delayed. Physical settlement requests face administrative reviews. One major bullion bank, I won't name them, but they're in the top 3 for silver derivatives, quietly cash settles 12,000 contracts they'd promised to deliver physically. That's 15 million ounces they don't have. The market shrugs it off. Mainstream financial media doesn't cover it, but the professionals notice. Physical dealers see their supplier networks fracture. Import-dependent refiners in India and Turkey report shipment cancellations. This is a controlled squeeze. China isn't cutting off supply completely. That would be too obvious, too aggressive. Instead, they're introducing friction. Permits delayed by weeks. Inspections that find quality issues. Shipments rerouted for additional screening. Meanwhile, the People's Bank of China has been accumulating silver quietly for 8 months, not through official purchases, through state-owned enterprises buying physical metal and storing it domestically. They engineered scarcity, then they announced controls, then they watched the paper market convulse. Here's what most people don't understand about silver markets. There are 2 completely different markets operating simultaneously. The paper market. This is COMEX futures, LBMA forwards, ETF shares, bank derivatives. It's leveraged, it's liquid, it's massive. Daily trading volume exceeds 1 billion ounces. That's more silver than gets mined globally in an entire year. The physical market, this is actual metal, bars and vaults, coins and safes, industrial inventory and warehouses. It's tiny compared to paper trading. Maybe 150 million ounces of physical silver changes hands globally per year. The paper market sets the price. The physical market determines who actually has the metal. And right now, those 2 markets are violently diverging. Spot price on COMEX? $29 per ounce. Reasonable, stable, nothing alarming. But try to buy 1,000 ounces of physical silver for delivery in Singapore, you're paying $33.50. Try to buy 10,000 ounces for delivery in Frankfurt, you're paying $35 and waiting 6 weeks. The price says there's no problem. The delivery times say there's a crisis. This is the signature of a market break. Not a crash, a break. The connection between paper contracts and physical metal is severing. I'm watching coin dealers in the United States sell out of inventory while COMEX prices stay flat. I'm watching industrial buyers offer premiums that would have been unthinkable 6 months ago. I'm watching the bid-ask spread on physical bars widen to levels I associate with 2008 and 2020. But here's the mechanism that's truly breaking. The COMEX system relies on something called the eligible to registered pipeline. Eligible silver sits in approved warehouses. When someone demands physical delivery, that eligible silver gets registered for delivery. It's supposed to be seamless. Right now, eligible inventories are dropping while registered inventories aren't refilling proportionally. That means one thing: metal is leaving the system faster than it's entering. Where's it going? Private vaults, sovereign storage, industrial hoarding, and increasingly, it's staying in Asia. China's export controls aren't creating a shortage yet. They're creating a perception of future shortage. That perception is enough to break the just-in-time delivery model that the paper market depends on. When fear enters a fractionally reserved market, the mathematics turn predatory. The CME can print infinite silver contracts, but China controls the refineries, and refineries can't print metal. If this pattern feels familiar, it should. China did this exact playbook with rare earth elements in 2010. They controlled 97% of global production. Japan needed those materials for electronics. A territorial dispute happened. China delayed rare earth exports to Japan for 2 months. Prices quintupled. Supply chains panicked. The West realized they'd outsourced strategic resources to a geopolitical rival. 15 years later, we still haven't fixed that dependency. In 2023, China restricted gallium and germanium exports, critical semiconductors materials. Prices spiked. Western chip manufacturers scrambled. Nothing changed strategically. Now it's silver and antimony. But silver is different. Silver is monetary, it's industrial, it's strategic, and the West financialized it into a paper derivative casino, while China quietly secured the physical supply chain. Let me show you the historical pattern that's repeating. Phase 1. Foreign dependency develops quietly. Western economies outsource production for cost efficiency. China builds refining and processing dominance. Phase 2. Financial engineering disconnects price from physical reality. Futures markets, ETFs, and derivatives create synthetic supply. Price suppression benefits industrial users and banks short the market. Phase 3. Geopolitical tension escalates. China recognizes leverage. Phase 4. Export controls activate. Not a ban, just friction, just enough to break the just-in-time model. Phase 5. Paper markets pretend everything's fine while physical markets dislocate. We are currently in Phase 5. The Hunt brothers tried to corner silver in 1980 using leverage and futures. The system changed the rules and crushed them. They were private citizens attacking the establishment. China is a nuclear-armed superpower with a 47% refining market share. They don't need leverage. They own the bottleneck. This isn't market manipulation. This is statecraft through commodity control, and the West has no rapid response. You can't build a silver refining industry in 6 months. You can't reshape global supply chains while contracts are failing. China spent 20 years building this leverage. They're activating it now. The question isn't whether this disrupts markets. It already has. The question is, how long until the paper market admits it? Now let me show you what the professionals are doing, because their behavior tells the real story. JP Morgan has been accumulating physical silver for 12 years through their COMEX warehouse. They hold roughly 180 million ounces. That's not speculation, that's reportable data. They've been steadily withdrawing metal from registered to eligible status. Translation: they're moving it out of the delivery pipeline. Why would a bank hoard physical metal while trading paper derivatives? Because they know the difference. Next, the iShares Silver Trust SLV, the largest silver ETF. 2 weeks ago, they disclosed temporary delays in physical audits due to logistical challenges with custodian verification. That's corporate language for, we're not sure all the silver we claim to have is where we think it is. The fine print in SLV's prospectus allows them to settle in cash if physical delivery becomes impossible. Most shareholders don't know that. Then there's the LBMA, the London Bullion Market Association. They're reporting elevated demand for vault storage and extended settlement windows for physical transfers. That's code for people are pulling metal out of the fractional system and demanding segregated storage. When professionals lose faith in pooled storage and paper claims, that's a systemic trust fracture. I'm also watching the US Mint. Silver Eagle production is sold out through February. Authorized dealers are rationing inventory. Premium over spot is $7 per coin. The Mint blames plancher supply issues. Planchers are the blank silver discs they stamp into coins. Who supplies those planchers? Companies that source refined silver globally. Guess where bottlenecks are forming? Meanwhile, industrial users are behaving like it's 2008. Solar panel manufacturers, massive silver consumers, are forward buying 6 months of inventory instead of the usual 30 days. Electric vehicle battery producers are locking in supply contracts at fixed premiums. This is fear-driven hoarding by entities that don't speculate. They just need the metal to build products. And here's the nightmare scenario the CME is trying to avoid: a delivery default. If a major bullion bank fails to deliver on a physically settled contract, confidence in the entire futures market collapses. Every contract becomes suspect. The discount between paper and physical becomes a chasm. Right now, the CME is quietly encouraging cash settlements. They're offering incentives to roll contracts forward instead of standing for delivery. They're managing a controlled retreat from physical obligation. But China controls the tempo. They can tighten export approvals anytime. They can loosen them just enough to prevent total panic. This is economic warfare through controlled stress. So where does this go? Scenario 1. China uses this as leverage in trade negotiations or geopolitical disputes. They ease restrictions after extracting concessions. Markets stabilize. The paper system survives. Everyone pretends it was temporary. Scenario 2. This is the opening move in a longer strategy. China continues tightening. Western supply chains fracture further. Paper market stress intensifies until something breaks. An ETF suspension, a major delivery default, a COMEX rule change. Scenario 3. Other nations follow China's model. Russia restricts palladium. South Africa restricts platinum. Suddenly, every strategic metal market fractures along physical versus paper lines. I'm watching 3 indicators to see which scenario unfolds. Indicator 1. Shanghai to London premium spread. If it stays above $5 for more than 60 days, we're in scenario 2. Indicator 2. COMEX registered inventories. If they drop below 100 million ounces, delivery stress becomes acute. Indicator 3. Central bank behavior. If other nations start accumulating physical silver in reportable quantities, that confirms scenario 3, strategic metal nationalism. Here's what this means practically. If you hold paper silver, ETF shares, unallocated accounts, futures contracts, you're exposed to counterparty risk. You own a claim on silver, not silver itself. If you hold physical silver in your possession, you're outside the fractional system. You have what institutions are scrambling to secure. The price might not reflect this yet, but access and delivery times already do. Industrial users are already paying the certainty premium. They're paying above spot just to guarantee delivery. That premium will spread to retail markets, then eventually to spot prices. This isn't a prediction. It's a mechanism. When physical supply tightens and paper claims multiply, the gap must close, either through price explosion or system restructuring. China knows this. They engineered the conditions. Now they're watching the paper market struggle with physics. You can print infinite contracts. You cannot print metal. And when a nuclear-armed superpower controls the refining bottleneck, they don't negotiate. They dictate terms. Let me bring this together. China activated export controls on silver. The paper market pretended nothing changed. The physical market started breaking immediately. Premiums spiked. Delivery times extended. Institutional players started hoarding. The gap between contract price and real metal widened. This is not a market fluctuation. This is strategic metal warfare. The COMEX system depends on infinite paper claims backed by limited physical inventory. That model works only when nobody demands delivery. China just made people demand delivery. We're watching a slow-motion bank run on silver, not in price yet, in access. The professionals see it. JP Morgan's hoarding. Industrial users are panic buying. ETFs are showing stress. History shows this pattern. China controls the resource. They apply pressure. The West realizes dependency. Too late. I don't know when this breaks, but I know the architecture is failing. Paper markets operate on confidence. Physical markets operate on possession. When those two realities collide, possession wins. China has the refineries. They have the leverage. They have patience. The CME has contracts, lots of contracts. Watch the premiums. Watch the delivery times. Watch what the banks are doing, not what they're saying. This story is just beginning. And the most important thing to understand is this. You can't solve a physical shortage with financial engineering. The metal is either there or it isn't. Right now, increasingly, it isn't.